Imagine waking up and finding out the government just told credit card companies, yeah, that 29% interest thing, not anymore, max 10%, period. If you've got credit card debt, that sounds like winning the lottery. If you're a bank, it sounds like a horror movie. And if you're an investor, it's a giant red flag that the rules of the game might be about to change. Welcome back to the comment section with Thomas Paul. Today we're breaking down this idea of a 10% cap on credit card interest rates, what it actually means, who wins, who loses, and what happens next if this kind of policy ever becomes real. Let's start with the claim, a hard 10% ceiling on credit card interest. Right now, the average credit card APR is around the low 20s. Many people are paying 25, 28, even 30% on revolving balances. So, on paper, dropping that to 10% sounds like a massive rescue plan for the middle class. But here's where things get interesting. Anytime a politician says, "Don't worry, we'll just force companies to charge less," there are three questions you should immediately ask. 1. Who pays for the difference? 2. What gets quietly taken away? And 3. What breaks when the math stops working? Let's walk through this with real numbers. Say you've got $10,000 in credit card debt at 25%. You make the minimum payments. You're not a villain. You're just like millions of people. At 25%, interest alone is $2,500 a year, and that compounds. It's brutal. Now imagine that rate is capped at 10%. Suddenly, your annual interest drops to $1,000. You'd save $1,500 a year just from the cap. Over time, that's the difference between "this will haunt me for a decade" and "I might actually get out of this." So I get why people love this proposal. If you're in debt, it sounds like someone finally picked your side. But wait, it gets even wilder. Credit card companies aren't charities. Their business model is very simple. Charge high interest on people who carry balances, use some of that to pay for rewards, fraud protection, customer service, and then keep the rest as profit. When you cap interest at 10%, you're slicing off a big part of that revenue. Some banks would still make money. Others, not so much, especially on riskier borrowers. So what do businesses do when their profits get squeezed? They don't just say, "Oh well, guess we're saints now." They change the rules. History tells us what usually happens when governments cap prices. Things don't just get cheaper. Access shrinks, quality drops, and new fees appear out of nowhere. Think overdraft fees, airline baggage fees, resort fees at hotels you booked for a one-night stay near an airport. When one fee is regulated, another mysteriously shows up. So, with a 10% credit card cap, here are the likely moves. First, banks tighten who gets approved. If you have great credit and a stable income, you'll probably still get a card, maybe even with better terms. But if your credit score is shaky, you're suddenly too risky for 10% interest. So your options shrink. Fewer credit cards, smaller limits, or flat-out denials. This is where it hits real life. A lot of people don't use credit cards to buy Lamborghinis. They use them because the car broke down and they need it for work, or the kid got sick, or rent went up and their paycheck did not. Cut those people off from traditional credit, and guess who steps in? Payday lenders, pawn shops, buy now, pay later apps with terrible terms written in tiny fonts, the stuff that makes 25% APR look friendly. Second, you'd probably see annual fees come back in a big way. Right now, competition pushed a lot of no annual fee cards into the mainstream. That could reverse. You might get 10% interest, but pay $100 or $150 a year just for the privilege of having the card. For some people, that's still a net win. For others, not so much. Third, rewards could get gutted. Those cashback offers and airline points, they're funded by interchange fees and interest from people who carry balances. If the interest side collapses, banks will protect their profits. Fewer rewards, worse rewards, maybe no rewards on the cheaper cards. So yes, a 10% cap sounds like a middle-class bailout, but underneath, it's a massive transfer of pain and incentives. Someone is still paying. It's just not obvious who in the headline. And here's the twist. Credit card companies are not small, helpless startups. They have armies of lobbyists and lawyers. If this ever got close to becoming law, they'd push back hard, drag it through courts, and if it somehow survived, they'd re-engineer their products to work around it. Maybe credit cards as we know them get replaced by new, flex pay accounts, or membership lines that aren't technically credit cards and therefore don't fall under the cap. These companies have entire departments whose full-time job is find loopholes. Now, let's flip this to the investor side, because this is where people forget the second-order effects. If you own bank stocks, or you're in index funds heavy on financials, a hard cap like this hits earnings. Lower interest income means lower profits. Lower profits, lower stock prices, at least in the short to medium term. Even if the cap never actually passes, just the threat of it can move markets. Banks might have to start disclosing regulatory risk more aggressively. Analysts may start modeling what-if scenarios. That's not great for valuations. On the other hand, some businesses might love this. If people can't lean on high-interest credit cards, they might use more debit. Or they choose store financing, or fintech apps, or personal loans. Some fintech and alternative lenders could see this as open season. And don't forget, if you cap credit card rates, what stops the next politician from saying, hey, that worked, let's cap mortgage rates, auto loans, personal loan APRs? You set a precedent, vote for me, I'll rewrite the contract between you and your lender. Whether you think that's heroic or terrifying, as an investor you have to treat it as risk, because it means the rules of the game are no longer just central bank sets rates, market handles the rest. It's the market handles it, unless the polls look bad. Quick pause, because this part matters. If you're watching this thinking, this kind of breakdown is cool, but I don't want to be on camera talking about it myself. This entire channel is run using an AI system called Fludge.io. It researches topics like this, writes a structured script, generates the avatar, creates the thumbnail, and uploads everything. You stay in control the whole time. You can tweak the topic, rewrite parts of the script, or even record your own voice if you want. Over time, it learns your style and gets better with every video. So if you've been wanting to start a finance or commentary channel without dealing with cameras, editing, or hours of research, Fludge.io basically removes all the friction and lets you focus on being the brain, not the production crew. Check it out if that sounds like your thing. Back to the 10% cap and what to actually watch for next. First, watch how this idea is framed. If the messaging focuses on helping the middle class and fighting greedy banks, that plays well politically. But it doesn't tell you anything about the details, and the details are where the consequences live. Second, watch for carve-outs. A proposal might say 10% cap, and then 30 pages later, quietly exempt business cards, certain types of variable rate products, or cards issued by smaller regional banks. That's where lobbyists start to earn their bonuses. Third, look at how the banks respond before anything passes. If you suddenly see more annual fees, lower rewards, or stricter approvals, that's banks preparing for a world where regulation gets tighter. They don't wait until the law is signed. They adapt as soon as they sense which way the wind is blowing. Fourth, pay attention to what happens to consumer behavior. If people believe they'll cap my rate at 10% soon, so it's fine if I run up a balance now, that's dangerous. Policy rumors can change behavior even if the policy never arrives. I learned this the hard way when I was about 12. My parents trusted a bank advisor who sold them on something safe for their savings. They didn't read the fine print. The advisor sounded confident. A year or two later, most of that money was gone. No headlines, no protests, just quieter dinners and a lot more stress. That's why whenever I hear politicians and banks both saying, "Don't worry, we've got you," I get nervous. Because I've seen what happens when regular people are the ones left holding the bag after the cameras move on. And that's also why, in my early 30s, I stopped chasing shiny, fast money ideas and started investing in boring, understandable stuff that worked slowly, not sexy. But it meant I didn't have to rely on credit cards to survive a surprise bill. So here's the verdict. A 10% cap on credit card interest rates sounds amazing if you only look at your next statement. It's relief. It's breathing room. For some people, it could be life-changing. But in the bigger picture, it's also pressure on banks to tighten credit, incentive for new junk fees and worse rewards, risk that the poorest and riskiest borrowers get pushed into even more predatory products, and a signal that politicians are very comfortable reaching into private contracts when it polls well. As a consumer, the safest strategy is still the most boring one. Don't build your life on credit card debt. Use them as tools, not lifelines. As an investor, factor in regulatory risk. If your portfolio leans heavily into financials, understand that the political climate can hit your returns, even if you think the policy is never going to happen. Markets react to fear and possibilities, not just signed laws. And as a voter, don't just listen to the headline, "We'll cap rates at 10%. Ask, okay, and then what? None of this is financial advice. I'm just some guy on the internet who watched his parents get burned by experts, worked in a newsroom that proved headlines can twist reality, and now prefers to walk through the second and third order effects before getting excited about big promises. Now I want to hear from you. Do you think a 10% credit card cap would actually help the middle class? Or would the banks just find new ways to make us pay and push the most vulnerable into even worse options? Drop your take in the comments. I read as many as I can, and I'm especially curious where you land on this one. If you found this breakdown useful, hit like so more people actually see it. And if you want more calm, data-first commentary on finance, investing, and the weird overlap with politics, subscribe to the comment section with Thomas Paul and turn on notifications. Because the headlines will keep getting louder, someone needs to quietly ask, okay, but what actually happens next?